Hi guys, Callum here. So, new video today. What are we talking about? We are going to be talking about the 18-year property cycle. Why the 18-year property cycle? Well, we seem to be in a boom phase at the moment with prices growing quite strongly. So I thought it would be an idea to research this model to try and figure out whether it's true or not for myself, and then to relay that information and the framework to you. So what makes me qualified to talk about it? Well, I've done loads and loads of research on it. I've read the boom and bust book by the guy who came up with the 18-year property cycle model. So I've tried to condense that for you guys so you don't have to spend a long time reading a 300-page book or 280-page book on Anyway, so what are we looking at today? The 18-year property cycle. So I'll show you what the 18-year property cycle is. I'll show you how it works and what to look out for in each stage, including what is in each stage. If you stick around to the end, I'll show you when to buy. We'll give you some advice or suggestions on how you can find the right time to buy, when not to buy, if there is a good or a bad time to buy, and what happens if you buy at the best and the worst times. So there we go. I'll show you how you can use the 18-year property cycle to make the best buying decisions so that you are an informed property investor. What are we going to go through? The different stages of the video, a bit of an introduction. I'm going to talk through the recovery phase, the explosive phase, the winner's curse, which is part of the explosive phase, the recession phase, and then just a bit of a summary on things to watch out for and what not to do. So here we go. Stick around to the end because that's when the best information is going to be. Like the video, subscribe to it, and see you in a moment for the intro. So what is the 18-year property cycle? It's the theory around property prices that's governed by supply and demand, or property prices being land prices. They're the same thing for the case of this video. The model shows that property prices move through an 18-year cycle as follows. Years 1 to 7 are the recovery phase, after the recession phase, and after prices hit their lowest. So that's where we'll start. That's years 1 to 7, and that's the first growth phase. After that, you have a mid-cycle dip, mid-cycle wobble, and then years 7 to 14 are the second growth phase, known as the explosive phase. The last couple of years of that explosive phase, so years 12, 13, 14, 13, 14, what's known as the winner's curse, according to Fred Harrison, the author of the Boom and Bust book. And then finally, years 14 to years 18 are the recession phases, and then it starts all over again. So why is any of this important to know? Well, understanding the stages helps us with making educated buying decisions, planning our strategies, and working out our goals, and when the best times to buy are in line with our goals to help us achieve those. So, as I said, who came up with it? It was Fred Harrison in the book. He wrote a book called Boom and Bust, House Prices, Banking, and the Depression of 2010. This was written in 2005, where he was predicting a 2010 depression. It's not just his opinion, it's not just my opinion, it's based on cold hard facts and previous sales cycles. Fred looked at data going back hundreds and hundreds of years to show an average repeating cycle of 18 years. It's an average, so it's not set in stone, it's not exactly 18 years to the day or to the month. It may vary from this slightly, but it is a very good guide, and if we can understand it as property investors, then we can wield it and utilize it to make good buying decisions. So there you go. That's a bit of the background onto it. Now we'll jump into a bit more about the history and the data, and then just quickly to give some context, and then the stages. So what does Fred Harris base this cycle on? As I say, the aim of the video is to help you make informed decisions around buying and selling property, not to understand the micro and macro factors behind this. That could be a whole nother video. You could even write a book on it, believe it or not. But some basic background and interesting facts just to help you understand. He wanted to understand what drove the cycles in order to drive policy that could prevent these crashes every 18 years to make a more consistent growth for countries. In the same way that he sought to understand the cycle, we can do the same in order to make better buying decisions. So what does Fred say? He says it ties in with the credit cycle, the macroeconomic cycle, and the business cycle, which, as he calls them, are violent beasts of the capitalist economy. Fred Harrison, the guy that wrote the book, predicted the 2007 and 8 crash in the mid-90s, and then looking at history, the model holds water with crashes in 53, 54, 71, 72, 89, 90, and then, as we know, 2007, 2008. Where does the cycle start? How far back does it go? Now this is quite interesting if you like history. It can be traced back to the 1700s, and it was done by a gent called J. Parry Lewis in his 1965 book, Building Cycles and Britain's Growth. Why the 1700s? Going back a bit further, when Henry VIII went through the dissolution of the monasteries in 1530, the land was claimed by the crown, and then the crown then sold that land to raise revenue. So by the end of the 16th century, 1600s, full trading conditions were in place for sort of modern land law as we know it today. And actually the turn of that century, the 1600s, saw the first property price boom. The next booms, according to the data, were in 1617.5, so almost 18 years later, and then again after that in 1635. And so there is where it started, and from there we can actually trace these there or thereabout 18-year cycles all the way up to 2007, 2008, and the modern day, as I'll show you shortly. So there's a bit of the history. Next, we'll look a little bit at the different stages of the cycle. So what drives the cycle and markets? It's land and property prices, or the finite nature of land and property prices. They're the same thing. The role of credit and banks and lending houses' willingness and ability to lend. It's worth noting that each cycle starts at a higher point than the previous cycle, so although there are peaks and troughs, it is, if you look at the trend, steadily upwards. So that is something to bear in mind when we're looking at these trends and making buying decisions. So years 1 to 7 is the recovery phase. What do we see during this phase? Prices bottom out from the previous peak in the previous cycle. Reluctance to lend. It's difficult to find finance, so there won't be many, mortgage options out there. They'll be difficult to come by. Banks will be very stringent on lending. Cash-rich buyers will enter the market. They'll get good deals because prices have bottomed out. So if you've got cash, perhaps a good time to buy. Some people will still be selling to avoid further losses because they think the market's just going to keep falling because they're not aware of the 18-year cycle, that they don't understand that it's bottoming out and it'll come back. So some people are continuing to sell. That being said, there are deals to be had. So looking at figures from the current cycle, just to back this up, we could say that the recovery phase at the moment started in about 2012, so that's 4 years after the crash, and it's led up to about end of 2019. What does the data say? Does it back this up? Hopefully on your screens will pop up a house price growth chart from the Office of National Statistics, and we'll highlight the areas where these bits start and end. So house prices started at £165,000 and they ended at £233,000 over that 7-year recovery phase, which is the first of the growth phases. So that's over 7 years, a total of 41% growth, or 5.8% per annum. Does it hold water? Yes, that bit holds true for the current cycle. So what about the next bit? The mid-cycle dip. So is this true? Is it true for our current cycle? Is it true for other cycles? Well, it's true for other cycles because we've seen the data. What characterises a mid-cycle dip? Mid-cycle dip, this happens at the end of the first 7-year growth phase. Why does it happen? Well, as I say, there's people returning to the market, demand is increasing, but the supply is still not there to meet that demand. So we have a bit of a boom, a bit of a rise, and then a dip in property prices. People are still cautious of what happened in the previous cycle. So that's what we see. Let's look at the current cycle. Does this hold water? Well, looking at the data again from the ONS, it would appear that the mid-cycle dip happens, the peak happens in September 2019 at £234,000 average UK house prices, and then the trough or the bottom of that dip or wobble actually happened in January 2020 at £230,000. So a little bit of a fall there, which took place over perhaps a 6-month period for that whole mid-cycle wobble. After the mid-cycle dip, which we're saying, looking at the data, again, it could be wrong, so don't call up or comment saying I bought a house because of you and you were all wrong. The data's there for everyone to analyse, so go and analyse it yourself. This is my interpretation of that data. So after the mid-cycle wobble, you have years 7 to 14, which is the second growth phase of the property cycle, also known as the explosive phase. This is broken into two sections. The first 5 years of that explosive phase and the last 2 years, which are known as the winner's curse, according to Fred Harrison. What are the characteristics? What are the things to look out for? Prices are growing rapidly, growth is happening at a high rate, lenders are willing to lend. You read lots of articles in the papers about growing prices, and people start to jump on the bandwagon. According to Fred Harrison, people are incautious, they use their homes as a way to build wealth, trading up, driven by greed and fear of missing out on super profits. So, the explosive phase. Are we in it now? If the mid-cycle dip happened in January 2020, then perhaps we are. Let's look at the figures from the current cycle. April 2020 to now, or April 2021, even 12 months. In April 2020, the average UK house price was £230,000 according to the ONS. In April 2021, it was £256,000 according to the ONS. And if you look at the website, you can see that's a 12-month growth of 10.2% in the UK as an average, with some areas reaching 14%, and the Midlands, for example, doing 12%. So 12 months, 10 to 14% growth would suggest we are at the start of that explosive phase. So one of the characteristics of the explosive phase is more and more people jumping on the bandwagon, people talking about it, articles in the press. As I sort of sat down to read the paper this morning with my morning cup of coffee, opened up the paper, and here I've got it here, the article from the Wales Online, a lovely paper, but they do reference where they got their information from, so we can trust it. House prices see huge rise after busiest first 6 months of the year ever. Now that is a classic explosive phase headline. People read that and they're like, I've got to get involved in that. How do I do it? And the momentum keeps building. So the busiest first half of the year ever recorded by Rightmove, so we know where the data is coming from, pushes the average UK prices of property coming to the market to a new record high for the fourth consecutive month, and £21,389 higher in just 6 months. So they're saying Rightmove is saying a 6.7% increase in just 6 months. Are we in an explosive phase? It's looking like it. The new all-time high of £338,000 as the UK national average is due a monthly rise of 0.7%. And the property portal states this is the largest monthly rise at this time of year since July 2007. Tim Bannister, Rightmove's Director of Property Data, said, "We predict that the number of completed sales will be the highest ever seen in a single month when June's HMRC data is released. This means the first half of 2021 has seen a record number of moves when compared with the first 6 months of any other year. This is induced by the pandemic side effects of a new focus on home and people wanting to move to a bigger space. Yes, it's been driven by that, but it also looks like part of a wider underlying property cycle." Okay, so we move through the explosive phase, which is the 5 years, massive house price growth, which we're seeing at the moment, into the final 2 years of that phase, which is known as the winner's curse, according to Fred Harrison. Now, again, from Fred Harrison's book, I just wanted to read you a paragraph here of what makes up the winner's curse, what's going on in that period, and things to look out for, again, so you can identify potentially what part of the cycle it is, and it will help you make your buying decisions. So, according to Fred Harrison, the third phase of the 14-year growth period lasts for about 2 years. The trades in houses are now almost exclusively driven by the motive to speculate in the prospect of reaping huge windfall gains, which is obviously accentuated by articles such as that from the Wales Online. We might have to beat that out. The price of land takes off in an almost vertical trend under the influence of what is known as the winner's curse. This is the period of frenetic trading in which prices can no longer guide people towards rational decisions based on what something is worth. This is most evident in property markets. Investors become reckless to the point where the winning bids for property are made by people who make the greatest upward errors in the assessment of what something's worth, not its underlying value. The psychology is primitive. The property must be acquired at any cost. So convinced is the purchaser that a windfall fortune is there for the taking that he will outbid all comers, whatever it takes. As prices escalate, the gap between reality and fantasy widens to breaking point, which does obviously eventually come in the recession phase. So The key characteristics of this phase is gazumping, where vendors will double cross people whom they've already agreed to sell in favour of latecomers who trump the price. This is the process of random errors in action on the doorstep. The winner's success is a curse to him and everyone else. The price is unbelievably high, unsustainably high. What happens? Confidence is then lost and we enter the recession phase. Okay, so what follows the winner's curse and the explosive phase? It's a recession phase. This lasts for a period of 4 years, there or thereabouts. We all sort of know what goes on in a recession. You know, prices fall, lenders aren't willing to lend, people aren't wanting to buy, you can't get finance, you know. People are still trying to sell because they're worried the market hasn't bottomed out, which is fueling further price falls, and people that over leveraged or took on too much debt or bought at the wrong time in the last cycle, you know, may not be able to afford keep servicing that debt, so they're forced to sell, which brings more supply, which, you know, further pushes down prices. But for the other stages, we've looked at the current cycle to see if it holds water. We can't do that here because we're not there yet, so let's look at 2008 to 2012, or that period following that crash. Looking at the data from 2008 at the bottom to 2012, where prices started to rise again, we can see just £10,000 worth of growth in the average UK property price, from £155,000 to £165,000. That's growth of 6.4% over 4 years, or 1.6% per annum, which is a far cry from the 10 to 14% we're seeing at the moment. So there you go. So that's the recession phase. After the recession phase, we go back to the recovery phase, which is the first 7-year period of the 18-year cycle. There we go. So guys, just to help you visualize how all of that fits together in the current cycle, I'm going to show my screen, or do a recording, a screen grab of my screen, and show the chart from the ONS showing what's gone on with property since 2006, just to help you visualize the cycle and where we are at the moment, to help you with making buying decisions and understanding it. So here we go. As we can see here, this is house prices from January 2005 to April 2021. So to talk it through, 2005 here up to the peak of 2007, late 2007, this would have been the explosive phase and the winner's curse phase during the previous cycle that we all know about. Then, you know, prices fall, they fall, they fall, and we have that sort of recession phase where there's not really any growth going on. From my research and the way I looked at the figures, you know, for me that's from about there to about there, that 4-year period where there's only, I think we said 6.1% growth. Thereafter, we see the recovery phase, which is a 7-year period, which, you know, we believe is taking place 2012 through to 2019 here, where we see a bit of a peak and then a slight dip there, which would be the, you know, the mid-cycle dip, and then prices will start to recover, boom, into this massive growth, explosive phase. So looking at the chart here, you know, we can see winner's curse, explosive growth, bit of a fall in prices or a fall, you know, recession phase, 7-year growth phase, mid-cycle wobble around here, and then up to the explosive phase there. So what does the data suggest? Well, the data would suggest that we are indeed at the start of an explosive phase in property prices. So is this true? It appears to be so, but, you know, we've never had a COVID before, so we don't know what the long-term impacts of that are going to be. If anything, in previous cycles there have been, you know, events outside of the control of the cycle that haven't seemed to have affected it. So, you know, perhaps the cycle will still hold true. There we have it. The bit of info on the property cycle, where it started, the different phases and the characteristics of those phases. So the magic bullet, or the answer you've all been waiting for, is when is the perfect time to buy? And probably a lot of you won't really appreciate the answer, but there is not really a best time, a wrong or a right time to buy. It obviously depends on what you're trying to achieve, but personally, if you're buying and holding for the long term, you're going to be able to ride out any 18-year property cycle. So it doesn't actually matter what period of time you buy in during that cycle, you're still going to benefit and make money in the long term. If you're looking at shorter term flipping and stuff like that, then there is obviously going to be more risk involved in that. So that's where you've got to look at your goals and your strategy and decide for yourself. But long term, you can't really go wrong with buying and holding. The data would suggest we're at the start of the explosive phase now, which means we've got 5 years of massive growth. So is now a good time to buy? Yes, it probably is. Key lessons for me from that, you will obviously take your own away, if any at all. You might have not found the video very useful. Hopefully you have. Do your research, buy based on fundamentals and not sentiment. Sentiment drives the market in the frothiest years, so do your research. What is a house actually worth, and pay that for it. Don't get sucked into being gazumped. Should I wait for prices to fall? Is one we're getting a lot at the moment. No, you've got to be in it to win it, to use that cliche. But if you wait for prices to fall, you could be waiting for a number of years. And so what is the opportunity cost of that? Well, for me, it's the income of the property. When people talk about property, a lot of people just talk about capital appreciation, which is what's going on here with the property cycle. Try and ignore that. Even without capital appreciation, one of the best bits about property is the fact that you've got a consistent and reliable income every month coming from a tenant. So should I wait for property prices to fall? No, get in now, because if property prices fall in 3 years' time, you could have had 3 years worth of income. At £6,000 per annum, that's £18,000 worth of income from the property, regardless of what the capital appreciation is doing. So no, I don't think people should buy and hold, but again, that's just my opinion. If it doesn't suit you, don't listen to me, do what suits you. Something we've said before and sort of alluded to at the start is it's not timing the market. You don't want to time getting in and out at the exact right time. It's about time in the market. So your length of time in the market. Again, if you're in it for over 18 years, you're going to do well. If you get in at the start of the recovery phase, you're going to do well. If you get in at the start of the growth phase, you're going to do well. If you get in just before the winner's curse, then you're going to have to wait until we're into the recovery phase to start seeing gains again, depending on where you buy. So really, there is no wrong time. If you buy and hold, time in, not time in. Price changes in property will not impact the income you're getting from property. They'll impact the way it looks on paper and the yield, because the price will be higher, the yield will be lower, or the price will be lower and the yield will be higher, but your actual income, physical income, is the same. So if you're buying property to create income for yourself, then you shouldn't really be too phased about these different stages. So there you have it, guys. That's the property cycle, a little bit of the history going back to the 1500s and Henry VIII. What drives the cycle, the different stages of the cycle, and what to look out for. Our current cycle, where we are, and evidence and growth and figures from the ONS and the government's website and Wales Online, or Rightmove even, to back that up. Again, go and do your own research. If you want any more information, ask us. I'll send you a copy of the book. I'll give you a bit of insight into it. I'll send you the presentation I put together for this video if you want to have a look in a bit more detail. Go and see for yourself, and then make an informed buying decision about where, when, and how to buy based on your goals and what suits you. There we go. Thanks very much, and see you next time.